The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone, and welcome to Nova's presentation, 401k Loan and Distribution Basics with Melissa Cawood. Before we get started, I'd like to point out the panel on the top right-hand corner of your computer screen. You will see a drop-down section for chat. This is where you're going to enter in any questions that you may have for Melissa. Feel free to submit your questions at any time. Do keep in mind that the Q&A portion will be held at the end. If time does run out and your questions are not answered, or you have additional questions, you can send them to our email address, webinars@nova401k.com. Right below chat, you will see the handouts dropdown. Here you will be able to download today's material in PDF form. If you are unable to view or click on the handout, go ahead and send us an email and we can provide you with that PDF. If you are with us today to earn continuing education credits, please be sure to stay until the end to fill out our pop-up survey. This will allow us to track your time and participation. Certificates will be sent out within a week for those who have met the time requirement. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates, or visit our website, which is www.nova401k.com/webinars. Thank you so much for joining us today. I would now like to introduce from Nova's distribution team, head reviewer and trainer, Melissa Cawood.
Hi, thank you so much. All right, we have a lot to go over today, so I'm going to jump straight in. Just to start us off, I want to let you know that this presentation is very general in nature. Every plan document is a little bit different, and this is just going to cover the topics in a general form and not be a substitute for any kind of legal or tax advice. If you have specific questions or needing advice, we would recommend that you consult a qualified professional, depending on the situation, maybe an attorney or an accountant. But on the agenda here, we are going to go over the different distribution types that are available in these retirement plans, and we're going to talk about taxes on those distributions. We're also going to look at loans and look at how to calculate a maximum loan amount, and then what happens when a loan is not repaid. That's when we get into those defaults. We'll quickly touch on vesting and look at how to avoid some of the most common problems, and then just a cybersecurity reminder at the end. All right, the first thing that you need to know is that once money goes into a retirement plan, it does have to have a distributable event before that money can be taken out. These accounts are not the same as bank accounts. I know sometimes participants don't always understand that. They think, it's my money, why can't I just take it when I want it? It's not a bank account. There are certain tax advantages to contributing to these plans, so we do have to follow IRS regulations on when we can take that money out. On the screen there are some examples of what's known as distributable events, things that happen that would make the participant eligible to take money out of the plan. So we are going to go through these one at a time and look at them more in depth. The most common reason people are taking money out is because they have terminated their employment with the plan sponsor. Whether they got fired, quit, or retired, any of that makes them eligible to move their money. This distribution is a voluntary distribution that is requested by that terminated participant. Funds cannot be moved from the account until after their last day of employment. So if I put my 2 weeks notice in today, I cannot wait, 1 week before I take my money out. I have to wait after the 2 weeks has ended before I can move my money. One thing to consider is that final paycheck for the participant. Is it going to have a contribution that's going to post to their account in the plan? If that answer is yes, the participant probably would want to wait until after that contribution posts before they make their distribution. And just the reason is it can avoid them having to make 2 separate requests, which can involve 2 separate fees for that request. So in order to make it easier and more seamless for the participant, wait until that last contribution has posted. Now, if they don't want to wait, we are not going to force them to or deny their initial request. We can go ahead and do that initial distribution. Just know that they may have to have a secondary distribution in the future. Okay, if a participant has left and they do not move their money, there is an option under the plan documents where participants with smaller account balance can be forced out. Typically, we'll mail the participant a letter after they've terminated employment. That letter will have instructions on how they can make their distribution request, and it will tell them that if they don't take any action within 30 days, that their account will be forced out. There's a couple of reasons why we would want to do this. It helps to keep the plan clean, just first and foremost. It will eliminate those lost participants. The participant has terminated and they've disappeared and their address is no good, their phone number is no good. It can be really tough to track those people down. If they forget they have money in the account, which, you know, sounds like it shouldn't be a problem, but it is. They may forget, especially if it's a small account balance, and then it's really hard to find them and reunite them with their money. So by moving it out of the plan, you know, you don't have that issue. Once these balances are removed, they are not included in your 5,500 account. So that's really important, especially if you're getting close to that participant limit and getting close to being an audit. We want to make sure we stay under that if we can. And then if you have a lot of terminated participants with these small average account balances, that can affect your overall average account balance in the plan, which can affect your pricing with the record keeper. So there's just several reasons why this is a good idea. Now, your plan document does not have to have this provision in it, but if it does, then you do need to stay on top of these. So there's two different thresholds for these. The employer will initiate a distribution on the participant's behalf if they fail to take one on their own, if the participant's account balance is below one of these two thresholds. The two thresholds right now are 1,000 or 7,000, and we're going to talk about what the different thresholds mean on the next slide. When we're looking at the account balance, that's going to be the participant's vested account balance. And then if they have rollover money in their accounts in the plan, that can be included or excluded depending on how your plan document is written. If we exclude the rollover money, then even more participants are going to be able to be forced out. Okay, let's talk about the $1,000 threshold. This one, if your plan document includes this provision, anybody with less than $1,000 can be forced out and a paper check of their account can be mailed to them. They're going to receive 80% of that vested account balance. 20% of it is going to be withheld and sent in for taxes. And this distribution is taxable. If the participant is under the age of 59 and a half, they're also going to be subject to a 10% early withdrawal penalty. They will receive a 1099-R the following January to help them file their taxes. The issue with doing these is that when we are mailing the participants a paper check, a lot of times they think it's junk mail, they throw it away. If they didn't respond to the initial letter, are they going to respond to the fact that they got a check sent to them? Some of them do, some of them don't, and then it just kind of solves one problem but creates a different one in all these uncashed checks that at some point have to be tracked down and reissued. One thing that you could do is set that minimum rollover amount in the plan document to $1, and then we would treat everybody under that second threshold. Now, this threshold can go as low as $1 all the way up to $7,000, or if you want the two different thresholds in your plan, this one would be from anybody with $1,000 or more up to $7,000. Secure 2.0 Act that was recently passed up to this amount. It used to be $5,000, but it is now $7,000. So for these people, they're not eligible to receive cash. They have to have their balance rolled over to an IRA. And there are lots of solutions available. Nova has QTC, Qualified Trust Company, and we would be able to open an IRA for the participant on their behalf with that company. Each record keeper also has different solutions. So there's no shortage of options in the industry here. And what will happen is the money gets moved into an IRA for the participant, and then that company, all they do is try to track these people down. They do multiple locator searches every year. They send them all kinds of things. Their goal is to get these people reunited back with their money. We have started our Force Out project already for this year. So we are in the middle of working on these. If you have questions about this, or if you want to get this started for your plan, there's our email address on the screen there at the bottom. Please reach out to us. We would love to have these conversations with you. Okay, the next type of distribution, well, from here on, we're going to talk about options available for people who are still employed with the plan sponsor. The next most common one is probably the in-service distribution. Sometimes you'll hear it called age 59.5 distribution, although it's not necessarily going to be age 59.5. It just depends on how your plan document is written. This is an optional provision. Some plan sponsors or some plan documents do not allow in-services at all. Others might have it in there at age 65. But this type of distribution allows the employee to take money out of their retirement account while they're still working. There's lots of reasons people might want to do this, maybe consolidate their assets right before retirement. If there's a bigger purchase they needed to take care of, that they wanted to have completed before they retire, it just gives them options. In your plan document, you can have all kinds of restrictions put on these. You can restrict the money types that are available. You can restrict, put in like minimum amounts that they have to take. You can put in timing requirements, only one per year, for example. So every money type can have a different thing in there. There's all kinds of different provisions you can add. If the participant is age 59.5 or older, that 10% penalty tax will not apply to them, but it will be subject to federal income tax on the amount distributed. So the next distribution is the hardship distribution. Again, this is optional. Your plan may or may not allow this, but it gives access to the accounts in the event of an emergency that the participant might be experiencing. Again, you can put all kinds of restrictions in your plan. You can restrict the source types, you can put in minimum amounts, you can restrict the number per year, for example. This one is subject to federal income taxes and also a 10% penalty tax if the participant is under age 59.5. With these, they do have to provide documentation. That can be things like invoices, receipts, bills, estimates, as an example. Recently, the Secure 2.0 made it to where we can also, in place of actual documentation, we can allow the participant to complete a withdrawal certification, where they basically certify that, yes, I'm experiencing a hardship, this is the amount I need, I have no other sources of income, things like that. That's going to have to be based on your plan document. Some plans will allow this and some plans will not. So for the hardship, most plans are going to use the safe harbor definition for hardship. And that safe harbor definition limits the hardship reasons to these 7 listed here on the screen. So if a participant is buying their principal residence, if they need to prevent foreclosure or eviction on their principal residence, medical bills for themselves, spouse, children or dependents, post-secondary education for themselves, spouse, children or dependents, casualty losses, that is home repair, anything that's not going to be covered by their homeowner's insurance. It has to be for an event that was sudden, unexpected, or unusual, like their house caught on fire. It can't just be to replace a roof that's 20 years old. It have to be something kind of unexpected. They can take it for burial expenses for spouse, children, dependents, parents. And then the newest reason at the bottom there is if they have a hardship that was incurred as a result of a federally declared disaster. So if the participant lives or works in a county that was designated as available for individual assistance from FEMA, then that participant would be able to take a hardship for this reason. it's kind of, some of it often is home repairs. You know, if a hurricane came through and you have a lot of property damage, but it broadens it out even further. If they are having, if they had lost wages because they couldn't go to work for a week because their place of employment didn't have power and they lost out on income, they can actually take that lost income from their retirement account instead. So it just broadens it out a little bit more, many more reasons there to be able to take that hardship. So if they have one of these, they would submit their documentation or their certification, and then we would be able to approve that. Now, hardships have changed a lot in the last 5 years. So if you haven't worked on one in a while, you might be surprised how different they are. Back in the day, participants were required to take a loan first out of their retirement account if the plan allowed loans before they could take a hardship. They were not allowed to take investment earnings on their deferrals, and they had to stop contributing to the plan for 6 months. Also, Safe Harbor, QNEC, and QMAC sources were not allowed at all, regardless of your plan, for hardships. But now, all of that has changed. Their hardships do need to be a distribution of last resort. If you have other options available to you, you are supposed to go that route instead. However, they're not going to require you to take a loan anymore, because what was happening is that when they made those loan repayments, that was lowering their paycheck, and it just caused a further hardship for a lot of people. Stopping their contributions was unfairly punishing some people. They had a one-time random event, and then they couldn't, contribute to their retirement for 6 months. That also was kind of counterproductive. And so they've made some changes since then. Also, even newer changes is that self-certification. If you want to put this in your document, you can allow the participant to self-certify that they have a hardship instead of requiring that documentation. So the participant would still be required to maintain documentation, but it's going to be in their own files. If a plan is audited, all they're going to be required to show is a certification. They are not going to be required to provide documentation of the hardship. If a participant is audited, theoretically, they might have to be asked to provide that documentation. So they should keep it on file, but the plan or TPA will not need to provide that. We like the certification on the one hand, the faster processing, there's less paperwork and less red tape for participants. When they're having a hardship, it's a very stressful time for the participants, and us putting that on hold, asking them to provide all their medical bills, not only is that very uncomfortable, but it just adds to the stress in an already stressful situation. The participants still have to qualify for a reason. The difference is that we're just allowing them to kind of keep that more, they don't have to provide their medical bills, for example. They can just certify. It eases that administrative burden for the plan sponsor and, quite frankly, for the TPA as well. It's up to each plan how they want to write it, though, and it kind of depends. As a plan sponsor, you would know kind of your employees. If you felt like people would lie on this, maybe you want to continue to require documentation. But a lot of people trust their employees, and it is a legal document. They are signing off saying that they do meet the requirements. So it's kind of nice that this option exists, but you don't have to use it. Okay, so another distribution type is the rollover source. When a participant contributes rollover money into the plan, they are able to take that money out at any time and for any reason if your plan document allows it. Most plan documents do, because the goal, we want to get people to participate in our plan. And we want them to roll over their prior balances into our plan, because that helps our account balance average go up. The more money in there, the better, right? So one of the reasons participants are hesitant to participate is they are worried about the what ifs. Well, what if something happens and I need that money? This gives them the confidence to know that they're still going to have access to that money. But let's keep it invested as long as we can. Don't leave it there and forget you have it. Don't cash it out and pay taxes on it. Let's just roll it into this plan, and then we can offer this distribution type. It doesn't matter their age. It doesn't matter their reason for withdrawal, any time for any reason. It is going to be subject to federal income tax, and if they are taking this in cash before the age of 59 and a half, they will also have that 10% penalty tax. But they could roll it over if they wanted to. They could roll over their rollover money. That's perfectly fine as well. All right. When a participant passes away, their beneficiary will be able to take a death distribution. The funds are going to be distributed according to the election that the participant made. Now, hopefully, all the participants are completing beneficiary election forms, and those forms are being kept on file by the plan sponsor. If not, I highly encourage the participants to get those completed. It seems like most people don't complete them, just based on my experience. I'm not sure why, but more often than not, we don't have an election form from the participant. Married participants will always have the spouse as their beneficiary unless their spouse consents to somebody else being the beneficiary. So I think that's a lot of the reason most people think, well, I'm married, my spouse gets the money anyway, so why bother filling the form out? What happens though is that people get divorced sometimes and they forget to update any kind of election. Anytime you have a marital status change, we really need to get a new election form in there. And just by having it maintained by the plan sponsor, the employer, is more likely to know about those life events than, say, the TPA or the record keeper. So that's why if the plan sponsor can maintain those records, that's the best. If we have a situation where the participant did not make an election, the plan document will tell us what to do. It'll tell us who gets the money. It's going to state that order. So it will always, every plan will always say the spouse is going to be first. And if this person was not married, then it will go to their children in equal shares. If they did not have children, it's going to go down to the next line and the next line, and then finally it will always be the estate. Now in the middle, right here on the screen, it says like parents as example. Your plan document may not be written that way. I have seen some plan documents where they say siblings instead of parents. But if the parents are no longer alive, or if there are no siblings, then it would go on down to the estate. That'll be the last line there. Every beneficiary needs to complete their own form, and a death certificate must be sent in with the form in order for this to be processed. Okay. Required minimum distributions. In parentheses there it says age 73. If you probably remember, for a long time these were called 70 and a half distributions. But then it became 72 for a while, and now it's 73, and it will not stay at 73, but that's what it is today. These distributions are just an annual requirement that certain employees have, where they have to begin taking cash out of their retirement plan. Every single retirement plan has to have the R&Ds processed. So if a participant has a balance in 2 different plans, they need 2 different R&Ds. All IRAs also have R&D requirements, but the rules are a little bit different on how those can be processed. With retirement plans, every plan needs an R&D every year, and it's an amount that they have to take in cash. If a participant requests a rollover before the R&D has been processed, we have to do the R&D first, and then we can do the rollover. And that's just because the R&D amount is not eligible to be rolled over. It has to be distributed from the plan in cash. Now this is going to apply to people who are terminated once they reach age 73. If you are still working and you're 73, it's not going to apply to you unless you own more than 5%. Anybody who owns 5% or less, it's not going to apply as long as you're working. So you can take the R&D if you want to, but you do not have to until you terminate. If you are a greater than 5% owner, you don't have any kind of exception. You'll have to start at age 73. I like to compare R&Ds to Pringles. Once you start, you can't stop. So if somebody is not forced into taking the R&D, but they want to, they need to know that they're going to have to do it every single year. So there's no way to like put it on pause or anything like that. If you terminate and then get bored and come back to work later, you still have to take the RMDs. You can't stop it just because you were employed again. So NOVA initiates this for all of our clients. We go through every plan every year. We've already started that process for this year. And we identify who needs to take an RMD, and then we will prepare the form and send it to the clients for signature. So, all right. Let's look at Quadro briefly. These typically come up in the context of a divorce. It's a qualified domestic relations order. This allows an awarded amount to come from the participant's account and be paid to somebody else. It could be a situation where a husband and wife are just separating. It could be a full-blown divorce, or it could be actually due because of missed spousal, or missed child support payments. So the rules can get very complicated, and the type of quadro can, each quadro can be very different. It's not a one-day process. Typically, we get a DRO. It's basically a draft order. We'll look through it and make sure that the wording in there is acceptable under the terms of the plan, and then we'll send either an acceptance letter or a rejection letter and telling them what they need to fix. Then, once that's sort of been approved, it goes to the courts and it has to be signed off by a judge. Then, after the judge has signed it, that's when it becomes qualified. It's been reviewed and signed. Then the alternate payee can go ahead and take their distribution. But there's going to be a calculation that's done, depending on how the order is written. Usually there's a calculation where we have to calculate earnings, and we have to make sure that the correct amount is being distributed. So it can definitely take some time, especially depending on how long it's held up in court and things like that. So just know if you get any of these orders, send them to us. We will definitely review them with you and walk you through the process. Okay. Spousal consent is not going to be required for most of these 401k plans. If you had a plan that did require spousal consent, it is not going to be required. It's going to be waived if the vested account balance is less than that force out threshold we talked about in the beginning. I put 7,000 on the screen because that's the maximum amount. Most plans are going to have the maximum amount in there. If your plan only used the $1,000 threshold, then that would only be true up to that $1,000. The idea is that if I don't need your consent to move your money to an IRA or to cash it out, then I don't need your spouse's consent for the distribution. The plans that will always need spousal consent is if defined benefit or a cash balance plan, or if you have a defined contribution plan, but you have old money purchase plan money in there, that money type always needs spousal consent. So just keep that in mind. When I say most plans don't require, I'm talking about like 401k profit sharing plans. All right, a tax notice. Every time a participant receives a distribution form, they should also receive a tax notice. This just gives them information on how distributions from the plan are taxed and how they can avoid taxes by rolling their balance over instead of taking cash. It also explains the 10% penalty tax and when that applies, and just gives them all the information so that they can make an informed decision on how they want to handle their money. So for taxes, if the participant is taking cash, then 20% is going to be withheld if the participant chose cash instead of doing a rollover. If they're under the age of 59 and a half, that early penalty taxes, 10% would apply. There is an exception for terminated people between the ages of 55 and 59 and a half. But for most people, that 10% penalty is going to apply if they're younger than 59 and a half. Basically, the distribution out of the plan becomes taxable income. And because this money is typically deferrals, profit sharing, match, things that have never been taxed before, when they take that money out, that's when they pay the taxes on it. If it is Roth money, then Roth has already been taxed. But any other money type and earnings on Roth, if it's not qualified, will be subject to taxes. When there's a rollover distribution, that's how you defer it. No taxes happen at all until they get the actual money in their pocket. So they can do rollovers to an IRA, to another employer's plan. It doesn't really matter where, it's going to be handled the same. The only distributions that are not eligible for rollover that we've talked about are hardship or R&Ds. Okay, let's move on and talk about loans. Loans can happen from retirement plans. It's an optional provision. You do not have to write that into your document, but it allows participants to access their funds, which again, as we talked about, it encourages participation in the plan. They know if they have a what if come up, that they're going to have options. A lot of plan sponsors don't like loans because it can be a little bit of a burden, especially depending on your payroll system and things like that. The loan repayments get set up through payroll deduction, so it can get a little crazy when there's a bunch of loans in a plan. But you can set very restrictive provisions if you want. You can restrict the number of loans. You can put in loan minimum amounts. You can put in timing things, only one per year, or a waiting period in between loans. So there are ways to limit the number of loans that can be taken. Loans will not be taxable as long as they are paid back. And if you do not have loans and want to add it, or if you want to make changes, it would require a plan amendment. So everybody wants to know, well, how much can I take in a loan? The rule is, and this is going to be a regulation, this is going to be the same regardless of plan, that a participant can take 50% of their vested account balance up to $50,000. So if they have $50,000, they can take $25,000. If they have $100,000, they can take $50,000. They have $1 million, they can still only take $50,000. That $50,000 is also reduced by the highest outstanding balance during the last 12 months. If you have a participant with $10,000 in their account, that stipulation is never going to affect them. It's for the people who have like 6 figures, those larger account balances, where this can come into play. So when you're writing your plan document, NOVA would recommend that you limit it to one loan outstanding at a time, have a minimum loan amount of $1,000, and not require spousal consent. A minimum loan amount, you can't do anything according to regulations more than $1,000, but you could do less if you wanted to. Just keep in mind, the easier you make it for people to take loans, the more loans that your plan will have. So the requirements are that the loan must have a reasonable interest rate, and your loan policy will probably define that a little bit further. Most plans are going to use prime rate, and then they might add a percentage or two on top of that. It'll be defined in your plan document. The maximum length of the loan is 5 years. You can set a longer time if the participant is using the loan for a principal residence. But again, I've seen plans with 30 years in there, but the chances of a participant working uninterrupted for the plan sponsor for 30 straight years after they take that loan are, just the way the world is today, is not very common anymore. So we have to think about, are we setting up a loan that's guaranteed to be defaulted? Maybe, in your loan policy, you could put 15 years as the max on that. Now, you can write the loan policy, however. I've seen 10, I've seen 20, I've seen 30. But it is just something to think about. Anything that's not for purchasing a primary residence, the max is 5 years. Loans are paid through payroll deduction, so the participant is not sending a check in every month. It's coming straight out of their paycheck and going right back into the plan. When they terminate employment, loans become due. If the participant cannot pay that loan off, then the outstanding balance is going to be deemed as a distribution, and they will have to pay taxes just on the outstanding balance, not the original loan amount. It's very important that we follow the loan requirements listed in your loan policy. If they are not followed, then it will be considered a prohibited transaction, and that entire loan will become a taxable distribution. And if the participant's younger than 59 and a half, they're going to have that 10% penalty tax on top of it. So in order to prevent any kind of that tax burden, we want to make sure that we're following that loan policy perfect. There are fees. There is a loan initiation fee from both NOVA and the record keeper. The record keeper will also charge a maintenance fee. It's typically annual or monthly, but I have seen some quarterly. That is not something Nova charges, but the record keepers do because they're tracking the loan. The participant can log on to their account at any point in time and see where the outstanding balance of the loan, things like that. So there's a maintenance fee for the record keeper for that. It's usually pretty nominal. And the participants would bear the cost of these because they're the ones taking the loans. The interest that they're paying is going right back into their account. The interest on the loan does not get paid to Nova, the record keeper, the plan sponsor. The participant is paying themselves for that loan. So that's one good thing about them. In order, and this says expediting the loan process, but I would say this counts for distributions as well. Know the process before a participant asks you, how do I get this done? Some plans or some record keepers don't allow online, some only allow online. So know the process for your specific record keeper. If available, they need to apply online. It's so much faster. Always request an electronic deposit instead of a paper check if you're really worried about getting that money quickly. And then the participants just need to know that they do have to allow sufficient time to receive the funds. This money is invested. It needs to be liquidated, and then the next day the record keeper can send the money. So it's not as fast as like going to an ATM and getting a withdrawal. So just, they need to know, and we need to not overpromise the timing to the participants. Okay, so a couple of examples. Participant A's current vested account balance is $2,000 and they're requesting a loan for $1,000. This particular plan document does allow loans and they have a minimum $1,000. So that's good. They're asking for, you know, at least the minimum. We look literally at the vested account balance and take 50% of that. 50% of 2,000 is 1,000. So this loan would be able to be processed. The next example, we have a participant, same vested account balance of $2,000, but they already have an outstanding loan of $400, and they're requesting a new loan of $1,000. Let's see if we can actually process this. This plan document does allow 2 loans at a time with a minimum of $1,000, so they're not requesting less than the minimum. That's good. We have to look at 50% of their account balance. Well, that's $1,000. So that is okay, but then there's already a loan outstanding that we have to subtract from that account. So that's going to limit this person to $600. Because that is less than the plan's minimum of $1,000, this loan would not be able to be processed. Okay, participant C. This person has $100,000. They borrow $30,000 in April, but they fully repay it 2 months later. I'm sorry, they borrowed it in February and fully repaid it 2 months later in April. Then they applied for a second loan. This is where people really get tripped up. The highest balance in the last 12 months is going to come into play here. So 50% of their vested account balance would be $50,000. But when we subtract out the highest balance in the last 12 months, it's going to limit this person to $20,000. When you have a participant who is going to pay off a very large loan, if there is any chance that they are going to want another loan quickly after, I would recommend that that participant give us a call before they actually do anything. We can run the numbers, you know, hypothetically for them. If this participant took $30,000, repaid it really fast because they were like, oh man, I should have taken $50,000. I'm going to repay this and then turn around and take a $50,000 loan. That will not be allowed to happen. So I definitely recommend you have them call us and talk through their options before they repay a very large loan like that. I don't want anybody to be shocked when they find out that, oh, I can't take $50,000. Now I can only get less than what I paid back the first time, you know. Okay, loan defaults. This happens when a loan is not paid back, and we really want to avoid loan defaults. Now, when a participant terminates, that's technically going to be a deemed loan. The outstanding balance just gets deemed as a distribution, and you know, it's closed out, they have to pay taxes, and that's the end of it. With a loan default, they're still employed. And for whatever reason, the loans are not getting paid back. So we definitely want to avoid this. Especially, there's no reason for somebody who's still actively working to have a loan default. So that's why we recommend no participants sending in monthly checks. Inevitably, they're going to forget, or something's going to come up and they're going to say, well, I just won't pay it, or they're going to be late. So that's why take it straight out of payroll. That there can't be any issues there. When you have a participant make a loan request, set those payments up in your payroll system immediately. Make sure you have the correct start date, and then you can enter a goal amount. It'll be the payment amount times the total number of payments that need to happen, and have it set up, and it will run, and then it will turn off when the loan's been paid off. If somebody goes on a leave of absence, we can actually freeze a loan while they're gone. So that is okay. Definitely let us know and let the record keeper know, because different record keepers have different processes, but we can basically freeze a loan. Now the loan is still going to accrue interest, so when they come back to work, we will have to re-amortize the loan to account for that extra interest. But that is much better than having the loan default and the participant owing all those taxes. A loan can be put on hold for up to a year because of a leave of absence. They cannot extend their 5-year clock. So the loan maturity date is not going to change, but we can still have an option for them. Just because if a defaulted loan is subject to those taxes and potentially that 10% penalty tax, it can be a pretty costly mistake for a participant. So we want to try to avoid this at all costs. If you are missing loan repayments, it hasn't quite defaulted yet, but we realize we missed some payments. Maybe we accidentally forgot to set it up in payroll. We have time to fix it. There is a grace period built in. Basically, it's kind of a mouthful, but the last day of the calendar quarter, following the calendar quarter in which the first payment was missed, is the grace period. If you pull up the calendar and look at it, depending on when that first payment was missed, you're going to have anywhere from 3 months to almost 6 months to get it corrected. So if you realize that, let us know, and we can work with you and your record keeper, depending on the situation, to get it corrected. If they're only missing one payment, we might be able to just make a lump sum of the total amount missed. We might be able to double up next payment, something like that, and then you can just resume the schedule like normal. If they're missing quite a few payments, we can re-amortize the loan so that we ensure it still gets paid off in time. Okay, let's move on and talk about vesting. So we've talked a lot about vested account balance. So what is vesting? And that is just the employee's ownership right to the benefits in the plan. And that's going to accrue over time based on a schedule that is going to be defined in your plan document. There's many different types of schedules that you could choose from. You could have a 3-year cliff where the participant is 0% vested until they have 3 years of service, and then all of a sudden they're 100% vested. You could have a 4-year graded schedule where every year of service they gain 25% in their vesting until they reach 100%. There's lots of options available, and your plan document will define it. So the money types that this is going to apply for is going to be like employer match, employer profit sharing. It is not going to apply to any employee money, deferrals, rollover contributions. That's the employee's money already. They don't have to earn that. But the employer money, they're going to have to earn by years of service. There are certain money types that, due to regulations, have to always be 100% vested. That's going to be your safe harbor money, QNEC, QMAC, and kind of those rollover contributions as well. It's generally the employer match, employer profit sharing, are the top two. It's not the only two, but the top two. So there's 2 different ways that we can define what a year of service is. We can use the hours method, where they have to work a specific number of hours during the plan year to get credit for that year of service. Typically, it's 1,000 hours. And the vesting is going to start or be calculated from the original date of hire not the date that the participant became eligible for the plan. So their entire employment history is going to be looked at, even if they didn't contribute in the beginning. If you cannot track hours for whatever reason, it may be your employees are salaried and that's not how you run your business, that's perfectly fine. We can use what's called the equivalency method, where every month that the participant works, they get credit for so many hours. But once they hit that threshold, that 1,000 hours in a year, they get credit for a year of service. The average full-time employee is going to work 1,000 hours in about 6 months. So even some part-time people will hit this. Not everybody will under this definition, but some of them will. The other way to do it is called the elapsed time method. This is literally anniversary dates. So 1 year equals exactly 1 year. With counting hours in 6 months, you can earn 1 year of service, which to some people seems ridiculous. This one is a very literal interpretation, where it's literally on your anniversary date, you have 1 year of service. And so it does not matter how many hours they work, if they're part-time, full-time, none of that matters. They just get credit literally for their employment tenure. So if you have a plan document that says a 4-year graded schedule, once somebody in this method had been employed for 4 full years, they get credit. They would become 100% vested. So it's a way to encourage people to stay at your company longer, things like that. A plan does not have to do a vesting schedule. You could make your sources all immediately 100% vested if you wanted to, but you do have options up to 6 years that it could take for somebody to fully vest. Okay, let's talk about avoiding the most common problems. We get NIGO forms all the time. NIGO stands for not in good order. And we end up having to put them on hold, and sometimes we can't ever process them and the participant has to start over. So it can be kind of a problem. With distributions, the most common issue, believe it or not, is that we're missing signatures. Now, for the plan sponsor signature, that kind of makes sense. You know, plan sponsors oftentimes like us to review it first before they sign off on it. Totally fine. But I can't believe how many participants do not sign their forms. And the top reason for terminations is that we don't have the termination date. So that one, we always seem to have to put them on hold for that. You can help that by, if your participants have terminated, if you get that date entered into the record keeper site, then we'll always check there before we ask the plan sponsor for the date. NOVA only obtains a census once a year. So if somebody has terminated during this year, we're not going to know about it until we get the census early the next year. To a lot of other issues with paper forms are that we have trouble reading them, or they're missing pages. And those kind of issues can be avoided by the participant going online. You can't have missing pages, and also the participant can't submit it without fully completing it. So a lot of the issues that happen with paper forms just can't happen online, which is nice. With loans, we often have to put them on hold because we don't know the payroll frequency. We have to set up an amortization schedule, and I can't do that if I don't know, like, not only how often the participant is paid, but what their next payroll date is. So that's a big issue. And then the participants, for some reason, never on paper forms, they never want to fill in how long they want the loan for. They always leave that blank, and we have to put it on hold and ask them. We don't want to assume that they want 5 years, especially if it's a small loan. What if they only wanted 1 year? Again, with the online, they can't submit it without filling that in, so it's only an issue on the paper forms. With hardships, then the issue is always the documentation. Sometimes we don't receive any documentation. Sometimes we receive documentation that is just not acceptable at all. It might be incomplete, or it might be for, you know, a random reason that is not a hardship as defined by the plan. I had one yesterday where a participant sent in documentation for private school for their 3rd grader. It has to be post-secondary education expenses, not K through 12, as an example, where that one the documentation just wasn't sufficient. So the hardships are almost always put on hold unless the plan does allow for self-certification, and then as soon as we get that, it's processed right away. So I just, at the very end here, I want to talk about cybersecurity. Nova takes securing the participants' data very, very seriously. We treat the participants' data just like we would want our data treated. Any of the files listed here on the screen should never be sent via email without encryption. And I prefer not sending via email at all. When you send an email, even if you send it encrypted, it is going to be sitting in your sent box, and it then is getting into our inbox. Even if we delete it, then it goes to our deleted box. Like it gets multiplied, right? So there's 2 different boxes now and 2 different emails that put that data at risk. So if you do send it via secure email, I can tell you that we do fully will get it. We will put it on our system, and we will fully delete it out of the email so it does not exist in the email anymore. And we highly recommend that you delete it out of your sent box as well. We have a different option instead of email, where it is our secure web portal. It's that plan sponsor link. Hopefully you guys already know about this. There is a secure file transfer feature where you can just upload it to us, and then we don't have to worry about information that's sensitive sitting in people's emails that potentially could be phished. This setup, we have actually, you can upload the document and you can pick the employee that you're going to send it to. If you're going to send it to Nova Distributions, we actually set us up as an employee. So the first name is Nova and the last name is Distributions. The entire team, which is almost 20 people strong right now, has access to being able to download from there. So if you need to send something to one person on the team, let's just say me, and I'm on vacation, it's okay. Somebody else on the team will be able to grab it. So it's much better than sending it to an actual individual, because if they're out of the office, they're not going to see it. We do have encryption software. If you want to send something via email but don't have the ability to encrypt it, we can send you an encrypted email first that you can safely reply to. Just make sure you delete it out of your sent afterwards, and then delete it out of your deleted folder as well. One thing that we do, one rule that we have, just as an example, is any new plan contact has to be authorized by an existing contact. We're not just going to take Bob Smith calling us saying, hey, I'm a contact for this plan. I have no idea who I'm talking to. I don't know if that's somebody pretending to be Bob Smith or not. So they have to be authorized by an existing contact we know. Nova Associates, every single one of us, from the owner of the company down to the receptionist, we all have mandatory training every single quarter to keep up with the latest threats in cybersecurity. We also have policy passwords. We have lots of tools available to us so that our passwords are very strong and secure, and we're constantly looking and updating that. Just to give you guys some confidence, we take it very, very seriously. That's the end of the presentation. There's a reminder of, at the beginning, the CPA credit. Just keep an eye out for that email that will have the survey, and then your certification is going to be emailed within a week. Nova's provider number is listed on there if you want to write that down. And that's it. On the screen here, I have our main participant line and our main email. And then our team is actually split into 2 sides. We have a daily processing, like kind of daily, day-to-day loans and distributions. Our team lead for that is Blair, and her information is there. We also have our annual projects, things like our foresights and our R&Ds, refunds. Beth is the team lead for that side. We're one team with 2 sides, and her contact information is there. And then I train the staff, so my contact information is there. If you guys have any questions, feel free to keep this and reach out. And I'm very happy, all 3 of us would be very happy to answer any questions that you guys may have.
Awesome. Thank you so much, Melissa. It doesn't look like we have any questions, so we can go ahead and wrap this up. Just a few reminders on your go-to panel. You are going to see the drop down for handouts where you're going to be able to download today's presentation in PDF form. If you are not able to see this on your panel, you can email us and we'll send you the handout. Like Melissa mentioned, for CE credit, be sure to stay to fill out the pop-up survey once the session ends. And we will be sending the certificates within a week to those who have met the time requirements. For any other questions, you can go ahead and reach out to Melissa, Blair, or Beth. Anything else, you can send them to our email address, webinars@nova401k.com. To view any webinars you may have missed and the recording of this session, you can always follow us on our YouTube channel, which is Nova 401k Associates. Thank you so much, Melissa, for sharing your time and your knowledge with us today. Thanks again to everybody for joining. We hope you guys have a great rest of your week. Bye.